Well, let's connect the dots. The Federal Reserve expecting to begin cutting interest rates next year. The Fed releasing its updated forecast and its summary of economic projections, including its dot plot, which maps out policymakers' expectations for where interest rates could be headed in the future. Officials signaling in those projections that the Fed's inflation battle may not require another rate hike in the new year, penciling in 3 rate cuts, and they now see inflation falling to 2.4% in 2024. For more on what we heard yesterday and what that means for policy going forward, we want to bring in Nick Timiraos. He is the Wall Street Journal's chief economics correspondent. Nick, it's great to see you. Thanks so much for taking the time.
Thanks for having me.
So let's talk about what we heard yesterday, because it seems that the updated economic projections are confirming what markets have come to believe: more rate hikes ahead, or rate cuts, I should say, in 2024. Do you think, though, it might be a little bit too soon to declare victory, given the fact that inflation still remains a ways away from the Fed's 2% target?
Well, it depends on what benchmark you're using to measure inflation. So if you use 12-month rates, yes, inflation is not at 2% at a 12-month rate. If you take what we got this week out of the CPI and the PPI from the Labor Department, and you feed that through into what's going to be in the Fed's preferred gauge, which comes out later this month from the Commerce Department, that's the PCE price index, you're looking at a 6-month annualized core inflation rate of 2%. So over the last 6 months, the Fed is essentially at their target. And I think that's what reflects the pivot that you saw yesterday from Fed Chair Jay Powell. If you're hitting your target over the last 6 months, you're not going to declare victory because, of course, things could move back up. But you may not need to be at 5 3/8% much longer on the Fed funds rate if you're actually going to be back at 2 or even 2.5% core inflation.
And so if we were to see next year, because the expectation is that the Fed is going to continue in its inflation combating, but at the end of the day, how close will we actually get to their target, and will a 2 handle satisfy?
Well, I mean, they're at a 2 handle now, again, if you use the 6-month rate. And I think that explains why we saw a pivot yesterday. If you just go back 2 weeks ago, Jay Powell spoke in Atlanta, and he said it was premature to talk about lower rates, to speculate around when policy might be eased. Yesterday, he was asked about it, and he said, we did have a discussion around that. It sounded like a preliminary discussion, but it didn't sound like somebody who was saying it was too soon to think about when they would ease. So, it doesn't mean that they're going to cut interest rates in January, but it does seem like they could be moving ahead the discussions around when to cut rates after that if inflation continues to come down. And that, tracks almost exactly with what Fed Governor Chris Waller said a couple of weeks ago. I asked him a question about whether the Fed would cut rates even if the economy was doing okay, if core inflation was back to 2.5%. And he said, yeah, if we see 3, 4, 5 months of inflation behaving like this, then a Taylor rule would tell you, a standard monetary policy rule would tell you that you don't need to be at 5 3/8 on the Fed funds rate.
Nick, I'm curious just to get your thoughts on all of this, because leading up to this announcement, and not so much the decision, but the press conference that Powell held, I think some of his commentary, the U-turn that he seemed to signal, caught the markets by surprise. Did it catch you a little bit by surprise? And then in terms of some of the hawkish members of the Fed, do you think we're going to see them maybe back away from some of their aggressive rhetoric here going forward?
Well, we already have, right, with one more hawkish governor, which was Chris Waller. So, if you were paying attention to what Waller said, then what Powell said yesterday wasn't much of a surprise. I think, there was a disconnect in a couple of places. The first is in the policy statement, because really the dots are not a committee. They don't come to some agreement on the dots, but they do come to an agreement on what's in the statement. So what's in the statement? Well, the statement retained a very weak tightening bias, but it retained a tightening bias nevertheless. And so you have a statement that sort of seems incongruous with what the chair was saying in the press conference. The statement's saying we haven't decided, whether we've done enough. We think we've done enough, but we're not sure. We're not going to say that we're done raising rates. And Chair Powell sort of, kind of quietly made the same point in the opening of his press conference. But as the kind of live fire went on during the press conference, he was saying things, risk management, where, we don't want to stay too high for too long. We realize that's a risk. That isn't something that you heard him saying before when inflation was quite high, and he was saying we just can't fail on getting inflation down. So you see the 6 months progress. They're feeling better. You know, he said in a response to my question, we're seeing progress, we just need to see more. And one final point I'd make is that in the past few times that Powell has spoken, he has actually referenced the 6-month annualized core inflation rate, because the last 6 months have been so much better than the previous 6 months. And I thought it was interesting that he did not do that yesterday. He cited the 12-month inflation rate. The 6-month rate is at 2%. And I think it would have been a little, it might have sounded funny to say, well, we're not sure if we're done hiking, but you know, we're at our target on a 6-month basis. So he just didn't say it in the spot in the comments where he normally does.
Powell wouldn't declare victory for himself, but how do you see this? Do you kind of see this as a win for Fed Chair Powell and the FOMC?
What's not to like about where they find themselves right now? Inflation has come down a lot in the last 6 months. It was running around 4.5%. If you look at core in the first half of the year, it's running, you know, in the low twos, maybe a little bit higher in the CPI profile over the last 6 months. So you like that. The banking stresses, obviously there's still concerns in the banking system, but nothing like what we saw in March, April, May. So you've got to like that. The economy slowing down from the torrid pace of growth in the third quarter, but you don't see recession in the claims data, in the retail sales data. So what's not to like about this? I mean, the conversation they're having about, can we cut interest rates even if the economy is not weakening? That is a first-class problem for the Fed to have, and we should hope that it continues. It would be great for the economy if they're in a position to have that conversation and the economy doesn't go into a recession in the first half of next year.
Nick Timiraos, always great to get your insight here, especially on the day after a big day like yesterday. We appreciate you taking the time. Wall Street Journal's chief economics correspondent. Thanks, Nick.